Welcome, everybody, and thank you for joining us today for our webinar on credit markets trends to watch. My name is Jo Locke, and I'm Head of Credit Training here at Fitch Learning. I'm also a member of the Syllabus Committee for the Global Institute of Credit Professionals. Joining me today is Chiara Elisei from Reorg, who is Chief Credit Correspondent. Chiara, would you like to introduce yourself?
Indeed. Hi, Jo, and thanks a lot for having me today. My name is Chiara Elisei. I'm Chief Credit Correspondent at Reorg, which is a global provider of credit data intelligence and analytics for leverage finance, high yield, and restructuring professionals. Prior to joining Reorg in November 23, I was Chief Credit Correspondent in the Markets and Finance team at Reuters News, and prior to that, I was Managing Editor of the YA Europe.
Thank you very much. So we're here to have a discussion today, and if you have any questions as we go through the various topics that we'll be covering, please use the Q&A function on your Zoom to submit your questions, and we have some time set aside at the end of the session today to answer those questions. So let's get started. So to set the stage, we're going to discuss credit markets. Let's just think about the macroeconomic backdrop. So what do you think has changed this year compared to last year?
So the macroeconomic backdrop has definitely changed a lot and has improved a lot compared to last year, with now a soft landing likely in sight, even though it's not certain. And everyone in the market is looking forward to when central banks will start cutting rates. Now, this is a big improvement. Last year, we had the hard landing and higher for longer narrative in place throughout of last year. But however, when effectively central banks will start cutting rate is a bit of a moving target, I would say. Earlier in the year, at the start of 24, there were expectations that the ECB would start cutting rate as early as March. Now, a March cut is definitely off the table, and April also looks very unlikely. Market consensus is now for June. As everyone knows, the ECB will meet in 2 days on Thursday. And while, as I said, there's no doubt that they will keep rates unchanged at a record high of 4%, what will be interesting to see is what they're going to say. In previous meetings and occasions, they always said that they would take a data-led approach as to when decides, as to the timing for the first rate cut. And if we look at the data, particularly on the inflation front, there have been definitely some encouraging signs.
Yes.
As of last week, inflation in the Eurozone has been falling in February, even though not as much as expected, just to show that the road ahead might still a little bit bumpy. But in France and in Germany, the two largest economies in the Eurozone, inflation has definitely fallen, and it's at the lowest since mid-21. On the flip side, services prices remain strong, and the other key data to look at is definitely the labor market. So ECB President Lagarde said recently that the negotiated wage data for the first quarter, which is due in May, will be crucial for the timing of rate cuts, and that is why everyone is now looking forward to June. Beyond the ECB meeting this week, it's definitely a very packed week from a macroeconomic perspective. We also have the Fed's Chairman Powell testimonying in front of the finance committees. We do have US payrolls due on Friday, UK budget, Bank of Canada meeting, not to forget Super Tuesday today for US election. So just to wrap up, the markets at the end of the week might look different from what they look today or yesterday, because already there's been a little bit of softening this morning.
There's a lot going on then.
Indeed.
Oh, gosh. And in relation to that macroeconomic backdrop then, how are investors viewing the market at the moment? And what's at the forefront of their minds?
So investor sentiment has definitely improved in line with the macro backdrop, or even a little bit more. At the end of last year, we started seeing a strong rally in some asset classes, stock, but also actually in credit. And the strong momentum has continued into the start of 24. to the extent that some people have been wondering whether the market has got ahead of itself and got overly excited and whether the rally was too early and went too far. In that sense, we need to bear in mind that there are some conflicting signals. We mentioned some data about inflation in Europe, but also in the US, we've seen strong growth versus still some regional banks woes. So this is something that investors are definitely keeping in mind. I would say that the main things the things on top of their minds are inflation still, geopolitical situation, US election, first of all. And when it comes to the credit market, also liquidity in the market, that has definitely improved. But if say that inflation surprises on the upside in the sense that it is not falling as much as expected, or there are some other data that are not expected, there might be some volatility. So I think investors are bracing themselves for volatility ahead and perhaps some rapid market correction.
Okay, great. Thank you very much. So digging a little bit deeper, specifically thinking about credit as an asset class, how are investors viewing credit?
Yes, positively. There's been consistent interest into in credit as an asset class, and we have seen actually inflows into both investment grade and high yield funds. For investment grade, as of last week, we had the 17th inflow in a row, and for investment grade, that was the 11th inflow in a row. So definitely a consistent interest, even though the pace of the inflows slightly slowed down recently because there was a bit of a sell-off in government bonds. But in general, I would say that there's been lots of interest, including for the more riskier parts of the market, as investors try to lock in and to secure the juicy yields on offer. And because also they grow more confident in the ability of companies to refinance. So the markets are wide open in credits, both for bonds, but also leveraged finance, leveraged loans. We have seen throughout of last year in loans, we mostly see amend and extend transactions, while at the start of 24, we also started to see green shoots in new money supply of new leverage loans, and also waiver repricings, which is something that we hadn't seen in a while because issuers try to take advantage of the spread tightening and lock in better rates. Another thing that I think is another trend worth highlighting in credit is that some of the private debt facilities that are coming up for maturities are being refinanced by bank debt, by syndicated loans. So in a way, the banks are trying to win back some of the market share that they lost out to private credit funds in recent years.
Very interesting.
Yes.
Thank you.
Yeah.
Well, we can't really talk about credit without talking about default rates.
Very true.
So for a large part of last year, default rates were the top of investors' list of worries. Do we think those worries were overdone? And what do we think is the current expectation for default rates?
So I think that overall credits, corporates were more resilient than everyone was expecting at the start of last year. Definitely there was an increase in default rates in 23 versus 22. However, if we look at the total number globally of default rates in 23 was still below the levels seen in 2020 in the middle of the pandemic, when the COVID pandemic hit heavily earnings and leading to liquidity constraints for companies and missed payments and event of defaults. What is the expectation for 24? I think there is some consensus now that default rates might have peaked or are likely to peak in the first quarter of 24 and then gradually ease off throughout the year. However, if we compare to the global financial crisis and the pandemic, when again we had a spike in default rates, in those two cases, there was a rapid spike and equally a rapid decline. This time around, the expectation is that the decline in default rates will be a bit more gradual and default rates might stay close or above the historical average for 24. In In terms of type of default rates, the large part of them were distress exchanges, because that allowed distress exchange basically enable private equity or shareholders in general to try and preserve some equity interest, and they're definitely less expensive than a bankruptcy process. And finally, thanks to notes, is loan issuers were hit more severely by default rates because of the floating nature of the loans. So they were more vulnerable to interest rate increases.
More expensive to finance.
Yeah. Absolutely.
So default rates haven't spiked as much as was expected to be the case, but there are still some pockets of stress in the market, aren't there? So what is driving that?
Yes, definitely. There are still pockets of stress, and I think the main catalyst is still the refinancing wall. So companies that have outstanding liabilities that are coming up, they're coming to an end, and they need to be refinanced or repaid. So when, as I mentioned earlier, the debt capital markets are wide open, plus private credit is another financing source for borrowers that might be unable for different reasons to access the public debt market. And that is the big difference, having different options compared to large part of last year. So companies in general have been able to tackle the maturities, but it's not for everyone. So in general, typically companies need to have a refinancing plan in place at least between 12 and 18 months before the outstanding debt comes due. So any borrower, any firm which is inside that window of 12, 18 months is probably in trouble. And they might need, if they are, for instance, private equity backed, they might need some new money contribution from the sponsor to try and facilitate an amend and extend or a refinancing, or otherwise they might be heading towards a restructuring and a default event. So yes, the other, on top of refinancing as one of the main catalysts, I think that also falling profitability is a source of corporate stress. Companies have been grappling with rising cost and inflation for many months now, and to some extent they've been able to pass through cost increases onto the end customer, but now they also find themselves in need to try and boost sales, which means they might have to reduce prices to boost the sales. But if, for instance, rising costs, input costs continue rising, or the still stubborn inflation, this suggests that the margins might get squeezed and profitability will be impacted. So that's another definitely thing to watch out for in corporates.
Thank you. So if we stick with the sort of credit picture, if we dig into different sectors now, so what are the most topical industries at the moment and why?
I think that real estate remains the most topical sector across the pond, really, and probably the most distressed as well. Some countries, in particularly in Europe, Germany, which is probably something that we wouldn't have expected a few years back.
Yes.
But Germany and some of the Nordic countries have been struggling with real estate, particularly because some of the banks, especially smaller banks, are more exposed than some of their European peers to real estate, and not just commercial real estate, but also residential real estate is under pressure because with the interest rates, the cost of mortgages going up, housing affordability is coming under pressure. So I personally don't think, I'm not an expert of real estate, I personally don't think that at the moment, from what we've seen so far, real estate poses a systemic risk to Europe, to European economies and markets. However, I wouldn't be surprised to see some more casualties in the space. We've seen in Germany a number of corporates coming under distress, who also having to restructure their liabilities, going bankrupt. Same for the Nordics. So I think that there might be more. Another sector that investors have been looking at quite a lot recently is the debt collectors, servicers. which is a bit of a more niche sector. But it's interesting because the sector relies on non-performing loans portfolios coming up for sale from banks. There was a massive wave on the back of the global financial crisis, but then the volumes have been declined gradually. And clearly, with not as much volume, profitability has been impacted. And compounded by that, operators in the sectors face a maturity wall. So going back to my point about refinancing being a catalyst for stress. So I think at the end of last year, the more benign environment fueled hopes that this company might be able to navigate through the refinancing wall fairly easily, but something has changed recently, and this prospect looks less certain at the moment. And I think there is a little bit of a question mark whether the medium to long-term outlook for the sector, unless we have another big crisis and there are more NPL portfolios. Exactly. Hopefully.
Hopefully not.
Absolutely.
Okay, great. Thank you. So but I wanted to go back, and you were talking about refinancing, bond issuance, maybe even obtaining loans. If we just think about the sustainability space, what are we seeing in terms of sustainability-linked loans and bonds? And are we also seeing market conditions impact borrowers in this space and maybe distracting them from their ESG targets?
Absolutely. Absolutely. Last year was not a good year overall for sustainable finance. If we look at some data, we do have some internal data at Reorg, and for instance, sustainability-linked loans and bonds as a proportion of total loans and bonds issued last year went down, even though in absolute terms there was a little bit of an uptick in loans, sustainability-linked loans. A possible explanation for that is, for a large part of last year, the top priorities for corporates were refinancing and liquidity. So in a way, they try to tackle these priorities and kind of leave aside ESG, also because ESG draw increased scrutiny from investors. So in a way, they were just trying to get away with refinancing and, if in some cases, also liquidity constraints, without having to go under, as I said, additional scrutiny from investors. From an investor perspective, I think that there is a little bit of a overall reassessment, in the sense that I don't think that ESG is fully embedded yet in credit. I think that the investors are reassessing a little bit the greenwashing concerns, how the company are tackling them, but also seeking some greater clarity from regulators. And I think the market needs to be a bit more stable to see a sustained return of sustainable finance. It's hard to predict what is going to happen in 2024. The last things that I would mention is the outcome of election in a number of countries is also going to weigh heavily on this, because it might be, I don't want to say binary, but it's probably having a big impact.
Different priorities.
Yes,
different parties.
Absolutely.
Yeah. Just to focus in a little bit more on private credit. So a bit of a hot topic at the moment. Increasingly larger share of the credit market we're seeing being taken up by private credit. Do we expect that to continue as a trend? And may there be any disruptions in the private credit space?
Private credit is definitely very topical, and not just now. That is going on for some time, and there's been a debate in the market whether last year was the golden age for private credit, whether the strong momentum would continue into 24 and beyond. If we think that this asset class was virtually non-existent at the time of the GFC, and now has reached, I think, something like $1.7 trillion size. So has been a stellar growth in recent years. And I mean, it's an asset class that is here to stay, that's for sure. It does have a big reason to exist, like throughout of last year when the public debt markets were closed. I'd say, thankfully, there was private credit to offer an alternative That said, some of the banks have been trying hard to fight back, and we saw at the beginning of this year that they managed to refinance some of the private credit facilities with bank debt. So I expect a little bit of a more balanced dynamics between private credit and bank debt going forward. And anyway, in a market like the European one, which is very relationship driven, I think you can never really get rid of the bank debt. But at the same time, the private credit offers in some occasion is much quicker, can be arranged much quicker than bank debt. Other interesting things to say about private credit is, if we look at the fundraising last year, it has slowed down compared to the year before. Again, the overall market environment was difficult, was uncertain. There was lots of uncertainty, so that fair enough. But there have also been some recent press reports highlighting that pension funds and some other big investors are starting to become a bit more worried and nervous about the asset class, even though they're providing returns in the high single digit or even double digit return, which is amazing. And so far we saw low default rates. What I would say is it is difficult to assess default rates, for instance, because clearly they're not publicly rated as bank debt and bonds. So it's a little bit more opaque. And for me, the main concern about private credit is that it's a very young asset class. So it hasn't gone through.
Hasn't been tested.
Exactly. That's so far it's been resilient. In Europe, it started off in the middle market space, but now we see jumbo unit tranches so it's really taking on also the larger cap deals. But as you said, it is untested. So if things go for the worst, who knows? Yes, there might be disruption ahead.
Still be a little bit cautious there then.
Yes, I would be.
Yeah, great, thank you. Another subject that's been quite topical, AI, artificial intelligence.
Oh, absolutely, absolutely.
Quite interesting what's going on there at the moment. Any part of the credit markets where you see that there's already an impact, or where you think there may be some significant changes coming with respect to workflow or even deal making?
So that's lots of excitement. If we look at the stock side of things, the artificial intelligence bars and the stock have been really rallied massively. In credit, I think we're still a bit behind. I do see lots of potential, particularly when it comes to credit monitoring and risk assessment. I think that artificial intelligence and particularly machine learning can really have a vast application in credit and help with the interpretation of large data sets and also provide some instruments for flagging and identifying actually early signs of stress perhaps and risk management. That said, I think we are behind. I was recently moderating a panel about non-performing loans securitization, and one of the speakers on the panel is an expert in artificial intelligence, so definitely very keen about the potential. But with a big caveat, which is the quality of the data set. So for some parts of the credit market, I think that the quality of the data is still very patchy and even poor to some extent. So it is difficult to see the full potential of AI if you cannot rely on good quality of the data, of the underlying data.
Yeah. It's very exciting.
Yes, absolutely. No, there's definitely lots to look forward. I think, we only saw a little bit of it so far. That's
lots of opportunity.
Yes. Yeah.
Great. Okay. I think we'll have a quick look and see if we've got any questions. We were talking before we came online about Credit Suisse, weren't we? And AT1s.
Yes.
We have a question on AT1s. So how is the Euro AT1 bond market performance 1 year after the Credit Suisse write-down? Because it is March now.
Yes, it is actually. That's an interesting question. I haven't looked at recent performance of AT1, but what I can say is that I personally thought that the decision of the regulators on Credit Suisse 81 was negative and would have a long-standing effect on the asset class, and I was wrong, because the market absolutely came back.
Bounced back.
Yes, absolutely, and fairly quickly. Already before the summer break, and then even more after the summer break, we saw some AT1 issuance from European banks, and actually the premium there were. I mean, clearly everything can get done at the right price, but the premium was not as high as I would expect it in the first place. I think that definitely there was more scrutiny from investors and they wanted more certainty, particularly when it comes to Swiss issuers. But overall, the asset class has definitely bounced back from the lows that we saw a year ago.
And the investor confidence.
Yes, yes.
Yeah.
Absolutely.
Great. What about M&A activity? So M&A activity slowed down last year, didn't it? So that's also impacted deal flow in primary debt markets. So the question is, what is the outlook for M&A this year?
So yes, the outlook is way more positive than it was last year. We have seen already some deals coming to market, and I think there is excitement about a revival of M&A and also perhaps IPOs in throughout of 24. That said, there's always a little bit of prudence that is warranted because of the macro environment, but also some other elements like regulatory monitoring and scrutiny, the potential impact from election and political instability resulting from that. Strictly related to M&A, there's also the private equity outlook. And in that space, we saw recently some of the largest private equity firms in Europe being able to raise record funds. But on the flip side, we also saw some of the smaller, newer funds, private equity funds, struggling. So, which suggests that the market might go for a bit of bifurcation and perhaps some consolidation as well.
So another one to watch.
Yes.
So interest rate cuts, that's the big question area, isn't it? How are delayed interest rate cuts likely to impact credit markets? If we don't get the cuts that everybody's waiting for, what's the impact going to be?
It depends how long it's going to take for the first rate cuts. Clearly, as I said, already expectations have been scaled back from March to now June, perhaps in Europe. I think if we are talking about a few more months, and also it's not just the timing, it's also if they start late, then probably we will have less combined rate cuts than initially expected. I think the now consensus is perhaps for 90 basis points versus 150 basis points earlier. So I think it's going to have an impact, particularly for some of the issuers that have been waiting for that. So unless there have been some issuers that have been waiting, unless you really have to refinance, as I said, and you are getting into the window of 12 to 18 months, you might want to wait a little bit longer if your maturities, are starting to come up in 26 or beyond. You can afford yourself to wait because you're hoping that the central banks will start cutting soon. But then if they don't, you might end up in this situation where you're running out of time, which is never ideal for refinancing. So you need to strike a balance between trying to get the best environment and hoping that interest rates will go down, but also being able to give yourself enough time, because if that doesn't happen, you need to have a backup plan.
Very true. So this one, you may choose not to answer this one.
Okay.
This one is talking about the US elections. So which is your prediction for the US elections outcome, and how could both options shape the future? So answer which parts you would like, or you can pass on that one if you like.
Well, I personally think that, one option is worse than the others. Let's put it this way, very broadly. I don't think either option is completely ideal. Like I see some issues in both cases, not comparable. Don't get me wrong, absolutely. I think in one case that there will be lots of instability and really, I mean, we didn't talk about some other geopolitical issues, but we do have two big conflicts going on at the moment. We do have a big question mark about China. Today they released this ambitious growth plan, but that's also an ongoing tension between US and China. So things might actually escalate very rapidly in one case. Let's see. That said, it is a possible scenario. I'm not absolutely
rule anything out,
no, I don't know.
Just one more I've got here. What are the things to watch out for? So looking forward, maybe into 25, potential disruptions to the market. What should we be watching? Some of them we've talked about already, but anything that we might have missed?
Yeah, I think that we probably covered most of them. I just mentioned China. Consumer confidence clearly related to the whole macro environment, but also in general, I would say the amount of debt that is still in the market, both at the level of governments and at the level of corporates and private. We didn't talk about sovereign, but we had globally also some sovereign defaults and that big debt restructuring in the last couple of years. That's something that if things turn for the worse from a macro perspective, it can also cause lots of disruptions ahead. And finally, I would say that if there is one lesson that we have learned in the last few years is that unexpected can happen. I don't think that many people were expecting a conflict in Europe with Russia and Ukraine. And same for the pandemic. No one was expecting a global pandemic. So that just means that we need to be prepared for something and for quick market correction if not that I'm hoping for that, but I'm just saying some prudence and caution is warranted.
Yeah. Okay. I think we are out of questions. So that just leaves me to thank you very much.
Thanks for having me.
Great discussion. And thank you to everyone for your time and participation as well. And if you would like any further information on the Global Institute of Credit Professionals, on the Global Credit Certificate, or on the events that we are running, including like this one, then please visit our website, www.gicp.org. So thank you very much again.
Thank you.
Enjoy the rest of your day, everyone. Goodbye.